Thanks for clicking. Canada's real estate prices are set to drop by 25% into 2023, according to a new report by Desjardins. According to the new report, Canada is in for continued and significant price decreases for the next 18 months, though those decreases will vary significantly across provinces. While other banks have been releasing their reports on how far they think Canada's sales and prices will fall over the next couple of years, the report by Desjardins goes even more in depth, going province by province, looking at why and when sales will fall and by how much, and almost even more important, looks at when and why we can expect prices to rebound.
It's the economy, stupid.
So what I want to do today is go over the report, looking at the provincial real estate projections into 2023, look at how high Desjardins thinks interest rates will go, and when they think the Bank of Canada will reverse, and then go over what to look for next. We are expecting to get the national statistics for the month of July from the Canadian Real Estate Association any day now, and we'll obviously have updates out on those national stats on this channel. If you want to get those updates, make sure you click, like, and subscribe, but for now, let's get into Desjardins' report. The report by Desjardins begins at the national level, noting that prices have continued to decline 4% month over month since reaching their peak in February. Sales have also fallen off, but the pace of that decline has also moderated in the past few months. If we look at this graph, we see that sales fell significantly in April, but the pace of the drop in sales is expected to slow into 2023. While Desjardins issued a report in June predicting a 15% price drop in the average price of a home in Canada, it has since revised that estimate to 20 to 25%. Owing in part to a more aggressive monetary policy than they had initially anticipated, meaning they didn't think the Bank of Canada was going to go this high on interest rates.
Well, join the club!
But that 20 to 25% price drop is going to be felt very differently from province to province, with some registering minuscule price drops and some seeing major price drops across the board. Desjardins predicts that those provinces which saw the greatest price increases during the pandemic are also going to see the greatest price drops. Those provinces being Nova Scotia, New Brunswick, and Prince Edward Island. Desjardins says that the Maritimes saw a major influx into their real estate markets as the pandemic allowed for work from home, and buyers in some of the other provinces which had much more expensive housing sought to find cheaper housing elsewhere. So the Maritime provinces saw a major increase in demand. But now that the pandemic is over, the work from home trend is likely to reverse, and these provinces will see a major decrease in the amount of demand for housing, and as such will experience the biggest price drops. And it's this same dynamic that is going to re-prop up the housing markets in Ontario and BC, according to Desjardins, as employers demand that workers return to the office, as we see heightened immigration levels with the end of the pandemic, and further price declines continue. We're likely to see more and more of a shift from these maritime provinces back to BC and Ontario. So while we saw an exodus at the height of the housing market from BC and Ontario, Desjardins is predicting we're going to see those people come back, which will re-prop up the housing market. It will prevent major declines in the future.
Oh, thank goodness you're back!
So while Ontario and BC did see the most pronounced housing corrections at the beginning of the real estate reversal, Desjardins is predicting that likely the worst is over and our market will be propped back up by immigration, return to work, and by those home buyers leaving the maritime provinces. As for Quebec, Desjardins argues that the province is in much better shape financially than a lot of the other provinces, and with their income supports and more affordable homes have led Quebec to experience less of a downturn thus far, seeing only a 2% drop in their home prices, whereas the rest of Canada has seen 10+% drops in their home prices. As for the prairies, Alberta, and Saskatchewan, the report argues that the rise in commodity prices and hot job markets will prevent major price declines across these markets. And with affordability already much better in Alberta and Saskatchewan than it is in the rest of Canada, they too are likely to see less of a decline than we have seen in the Maritimes and that we're likely to see going forward. The report unfortunately doesn't spend too much time on Newfoundland only noting that although they will benefit from the increase in commodity prices, they won't benefit as much as Alberta and will still see some price declines, worse than Alberta, but not as bad as the rest of Canada. As for Manitoba, the report says that its housing market is much less volatile and as such hasn't experienced as much price swings, and its diversified economy will help protect it from any further major downswings in its real estate market. And all of these housing corrections are expected to continue into 2023 as the Bank of Canada reaches a policy rate of 3.25%. However, Desjardins is expecting that these housing corrections will cause such a bad recession in Canada that it will force the Bank of Canada to reverse course on interest rates from its 3.25%, which indeed will help to re-prop up the housing market.
We would be eternally grateful.
So, in summary, Desjardins is predicting that the real estate correction will be most pronounced in the Maritimes. It will be least pronounced in Alberta and Saskatchewan in the prairies. Ontario and BC have probably seen the worst of it thus far. Quebec is better off financially and shouldn't feel it as bad as some of the other parts of Canada. Manitoba and Newfoundland are fairly stable, and we're going to see a high interest rate, a high policy rate from the Bank of Canada of 3.25%, which will subsequently reverse once the housing market correction-induced recession comes to bear. Yet, I think the report makes a fairly large assumption on interest rates, mainly that the Bank of Canada will reverse course on interest rates once the recession hits. For all of the detailed analysis provided in this report, and there's a lot, it only mentions the word inflation twice in the entire document. And as we know, the Bank of Canada's interest rate is largely based off the inflation rate. And we've talked about this discussion on this channel at great length before. The big question going on right now is if we are still in that 7-8% inflation rate when and if the recession hits, will the Bank of Canada reverse course? Does it have the stomach to continue to raise rates in a recession when people are losing their jobs? Thus far, the central banks, the Federal Reserve and the Bank of Canada, have continued to raise rates and have said they will continue to raise rates into a recession, but it's not clear as of yet that that has been put to the test, although it is becoming more clear that this will be put to the test in the coming months and years ahead. So although this report provides some very detailed analysis, some very detailed projections, I would have liked to have seen some more consideration of the inflation rate in setting the central bank interest rate policy, because I don't think it's as simple as we hit a recession and the bank reverses course. I think there's going to be much more to it, and inflation is going to play a much larger role than was given credit in this report. With that said, time will tell, and we'll obviously have updates out on the Bank of Canada and the real estate market on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.